Stocks fall, oil prices jump as the Mideast conflict widens. Here to discuss unfolding events is Rob Haworth of U.S. Bank Wealth Management, and I'm Lisa Bernhard with Reuters. Rob, here in the U.S., where investors have largely shrugged off geopolitical events, we are seeing some jitters today in the market. Stocks are down. What do you think of the impact on stocks, both today and going forward?
Thank you, Lisa. Yeah, the launch of the missiles by Iran against Israel is first and foremost a human tragedy, and thoughts and prayers go out to any of those damaged by that. From the market perspective, interestingly, we were down early in the day before this, and I think investors are really still focused on the Federal Reserve and the soft economic data we got this morning from the Purchasing Manager Survey. That said, as we watch this conflict unfold, I think the key question is what happens if it starts to widen? Do others start to get involved? Does it get extended? And does that start to really impact oil prices a little more? The impact so far has been modest, and I think investors are going to be able to shrug this off for the moment as they focus more on the economic story, which may be getting better in China and is really fairly solid here in the U.S.
Let's pick up on a couple of those strands, the first being oil prices, which are up at last check about 3.5% today. So what is, if they continue to climb higher, what is the biggest impact here in the U.S.?
Rising oil prices are certainly a concern when it comes to consumers. Consumer sentiment has been fairly depressed given concerns about elevated oil prices. That said, even at these levels near slightly above $70 a barrel, we're still at the low end of what we've seen for the last year and a half. So consumers are probably still a little relieved that oil prices are low. What we'd have to watch for is that oil prices really start to spike further, meaning we get more supply constraints. Interestingly, tomorrow's OPEC meeting is probably going to set up supply expansion or ramping supplies from OPEC by year end. So while we're worried about constraints, it looks like inventories or supplies are going to expand, and that may put further pressure on oil prices. I would highlight, I went back and looked at the Russia-Ukraine crisis. When that invasion first happened, we had a gain of around 10% that first day, and we got prices over $120 a barrel. We are well below those at this point. And I think the market is thinking two things. One, they are well supplied currently. And two, demand is really not ramping at this point and may not until we see better data out of China.
You also mentioned the PMI manufacturing data, and today we had the JOLTS job opening report, which showed that there were more job openings last month, or actually in August, than economists had expected, 8 million job openings. Put all that data together and how you think that factors into the Fed's next rate cuts, which just yesterday Jerome Powell suggested might be two more cuts this year, each at 25 basis points, lower than that initial 50 basis point cut.
Yeah, I mean, a lot of data today. The purchasing manager surveys certainly tell us that the global economy is somewhat soft, especially manufacturing. That's to be expected. We've seen that for some time, so that was not really very surprising, but it wasn't being welcomed really by the market. Inside the job openings data, openings were up a little bit, but not a lot. Really, the key was what happened with the quits and the hires data, and both those were somewhat softer. So what that tells us is the labor market is softening, which gives some credence to the Fed moving ahead with rate cuts, probably still at the quarter point pace they talked about for the rest of the year in November and December. So it seems like it's affirming the path the Fed has for trimming rates, even though there were some concerns yesterday that Chair Powell was maybe a little bit hawkish in his comments and may not move as quickly as people hope. Today's data seems to affirm that there's room for the Fed to trim rates.
Here on our shores today, we saw some 45,000 U.S. dock workers go on strike on the eastern seaboard. As a financial advisor, how does that potentially concern you, and how can investors protect themselves from potential risks in terms of, companies that may be affected?
Yeah, Lisa, the dock worker strike is certainly concerning for us, but it's more about duration of that strike than the strike itself. So the longer this goes on, what we'll be watching is inflation pressure. because what will have to happen for these goods to get into the U.S. is they may have to be rerouted. Now, it sounds like there's been some rerouting already, where we're ahead of the holiday season. We've maybe pre-positioned some goods to come into the West Coast rather than the East Coast, where we don't have a dock worker strike on the West Coast, and so that could be okay for a little bit. But with that inflation concern, right, we'd certainly look to hedge portfolios for that inflation risk. Within sectors that are particularly impacted, the good news, if there is good news in this, and there never really is in strikes, but it is not impacting energy imports and exports, and it's not impacting grain imports and exports. So farmers are able to get their harvests out. That's kind of the good news. The bad news is the impact here is really retailers, chemical and industrial companies, and that's of particular concern as we're watching portfolios. We're not making any big changes yet. As we know, the largest components of the S&P 500 right now are still technology names, and they're not really being impacted by this at this point. But it's something we'll continue to watch and watch evolve, especially if it applies some inflation pressure.